Hello. Test. Test.
So everything we saw.
Yeah, very good.
So everything we saw.
Okay. Start to set it up. First things first. Of course. Here we have it. I don't know if you can see, but 6-6. Anyways, gotta start off the stream with the right song. You already know. To be less to be what?
for the bread butter buy setups just being reversed for sell setups here. All the parameters, pips per trade, how many hours the hold time is, all the statistics here apply the same, just reversed for what we saw in the buy setups. And everything that we're looking for bread butter sell setups is strongly related to kill zone setups. They must occur inside the kill zone. We're not looking to scalp outside of the highest volume session times of the day. London Open. New York Open.
Your father knows about saving money. Everything I'm wearing, I've had since boot camp.
Okay, down close days or bearish days, we're going to be revisiting the daily range just for completeness sake. When the market is poised to trade lower based on higher time frame institutional order flow, in essence, we expect the open to be at or near the high of the daily range. There can be a small rally above the opening price, and again, that opening price could be 0 GMT or the midnight candle in New York. Now, London Open posts the initial leg lower intraday, and then price will wait for New York Open. So the initial swing can see a rally above the opening price, doesn't have to, but generally that first leg in price is lower, and inside that initial price swing we'll be looking for, or we look for, let's say it that way, London scalps. There's a small little retracement that takes place between 5 a.m. and 7 a.m. New York time. This is the London lunch. It's pre-New York Open. Then during New York Open, we see the second leg generally of the daily range unfold. And usually if it's a high formed in London, we're seeing a continuation going on in New York until price hits the 5-day average daily range. until the 5-day average daily range low is reached. Then there's a retracement off of the low that forms between 10 o'clock and noon New York time. Okay, so the London Okay, so the London Open, we'll be looking for that scalp, the sell short in during the London session. And when the higher time for institutional order flow is bearish, we anticipate London session high of the day formation. The open at 0 GMT or 12 a.m. in New York can see a protraction phase higher in price. This can be scalped from the open or just below it prior to 1 a.m. New York time. The classic London Judas swing higher can be scalped even easier. The market retraced between 5 a.m. and 7 a.m. New York time, and this can provide a short-term scalp entry once a premium array is hit. Even after the ideal Judas entry point has passed, a 5-minute retracement can be entered short on to scalp the remainder of the London Open to 5 a.m. New York time. scalp the remainder of the London Open to 5 a.m. New York time. You can see here an example of scalping the London session. This is a redistribution. Price trades up to a fair value level, fair value gap, shorter block of that nature. Price comes down to an old low, and you can see the offset positions there, all inside of the London Open kill zone.
Websites your competitors don't want you to know, part 2. All you do is go to this website, and it lets you find out exactly how much your competitors are making by showing you how much traffic they're getting, where the traffic's coming from, and even which social media platform is driving the most business. It has a complete breakdown of all the recent ads they've been running, what type of keywords they rank for, and even the top competitors.
Scalping the New York session. When London Open confirms institutional sponsorship on the short side and posts the daily high, we expect to see New York Open to continue lower, unless a higher time frame discount array has been hit intraday and or the average daily range low is reached. We look for the intraday swings lower to determine premium range arrays to go short at in the New York kill zone. Using the 8:20 a.m. New York time for CME Open to anticipate the New York Judas swing to fade. Targets will be the 5-day average daily range low and the next higher time frame discount array found on a 4-hour 60-minute basis. If ADR low is reached prior to 10 a.m., take 80% off and leave a small portion on to capture any range expansion that may fill. And here's an example of scalping short the New York session. London has created a high today, trades lower, consolidation into a small retracement, 8:20 a.m. CME Open. The retracement up as the Judas swing goes up into a fair value gap and bearish order block. There's your redistribution, and price trades down into a fair value gap below price at the time of the entry in New York. Okay, scalping the London close. When the New York and London sessions have moved in tandem and the 5-day average daily range low has been reached and it is at least 10:30 a.m. New York time, expect a retracement off the daily low. Again, it has to be between 10:30 a.m. and 1 p.m. New York time. Now ideally, price should exceed the 5-day average daily range for this type of trade. So you really want to see an expansion on the daily range. And we look for a 5-minute failure swing at the low and a bullish order block to enter on. Different perspective in rework and price. Price trades down into a fair value gap below price at the time of the entry in New York. Okay, scalping the London close. When the New York and London sessions have moved in tandem and the 5-day average daily range low has been reached, and it is at least 10:30 a.m. New York time, expect a retracement off the daily low. Again, it has to be between 10:30 a.m. and 1 p.m. New York time. Now, ideally, price should exceed the 5-day average daily range for this type of trade. So you really want to see an expansion of the daily range. And we look for a 5-minute failure swing at the low and a bullish order block to enter on, risking 10 pips below the daily low and targeting 20 to 30% of the total daily range in a retracement higher. Keep in mind this trade can be very difficult to see pan out some days, as the range can and could expand far more than the average daily range low. Ideally, take 1-for-1. Reward risk. Targets based on a required stop at no more than 20 pips. And here's an example of that London close trade. Price makes a high in the London close time period, makes a failure swing to get up to the high of the day, and fails. It's a redistribution during the London close time period. Price trades down, returns into 20% of the daily range for a London close objective.
Imagine being able to build an app with your name on it, just by thinking about it. Meet Base 44, a complete AI creation platform. describe what you want and watch it take shape. You can plan, customize, and expand in any direction. From tools built for one to platforms ready for many. From passion projects to enterprise-grade systems. Everything is built in and ready to launch.
It's a new world of creation, where you can go as far as your imagination takes you. Can you imagine it?
Let's make your dream a reality.
Scalping the Asian Open. When the market is bearish, we can enter short at or just above the 0 GMT opening price and expect an expansion of 15 to 20 pips lower as the Asian range is established. Asian sessions can be traditionally very narrow, and while this trade has proven profitable in the past, like London close trades, we are looking at the lowest volatile periods of the daily range formation. Always aim for 15 to 20 pips in the session, as the range can be limited. On the basis, it will be the Asian range formation. Take full exit on scalps in this time of day. It's not optimal to expect a second leg in price. Avoid greed here, and if you are fortunate to get 20 pips, be content and exit. And here's an expect a second leg in price. Avoid greed here, and if you are fortunate to get 20 pips, be content and exit. And here's an example of the Asian session opening and selling short at the opening of 8 p.m. New York time for a sell. All right, let's talk about 5-day average. selling short at the opening of 8 p.m. New York time for a sell. All right, let's talk about 5-day average daily range. The average daily range for ADR does not have to fill for the day. Just because we have the indicator on our chart, just because we make it available to see an overlay on price action, price is not going to always trade to that level. And many times it'll fall just short of it or wildly exceed it. So it's a general rule of thumb. Again, it's the average, not the absolute range, okay? It's the average daily range. So it could be a little less, it could be a little more, but it gives us a range to reach for where we can blend PD arrays on the lower time frame and up to a 6-minute or 4-hour chart. So by blending these things, also blending it with the central bank dealers range, with the pivots, with the Asian range projections and standard deviations, by having all these things overlapping and using the average daily range highs and lows, it will help formulate a probable objective for the day. And until that objective is met with the overlap or confluence of all the filling of the numbers levels that we look for, in between those ranges we can see scalps form. Ideally, you're going to get one in London, you're going to get one in New York, and you're going to get one in London close. Maybe, not always, but maybe you'll get one in Asia. Not on every single pair. Most likely you're going to see something form, like I said, on a daily basis in one of the majors if you follow them all.
Place trades with simple order management tools. Access over 40 built-in indicators plus custom indicators. Get real-time.
Now, average daily range, or ADR, can be expected to act as 1/2 of the actual average daily range in some conditions. What do I mean by that? Well, if we have an average daily range of, say, 50, and the ADR is calling for 50 pips for the day, if we are in a condition when long-term trends are underway and an intermediate-term swing has begun, a large impulse swing can surge the daily range twice the average daily range, especially when ADR is under 60 pips. 60 pips is like a number I like, and it's just over the years I've seen that as a filter or a buffer, if you will. If we see 60 pips or less and the conditions are likely that we'll see a strong directional move, higher or lower, doesn't make a difference. We're obviously going to be looking to trade in the direction, in the most likely institutional order flow, if it's bullish or bearish. But if we are expecting large ranges and the average daily range is calling for 50, chances are we could probably see the ADR double. And when an intermediate term price swing is completing at a higher time frame array and on the strength of high impact news, this is usually capitulation. That means the move's been going on for a while, it's finally reaching an objective on the daily or weekly levels, and once it hits that, it's going to reach for it to get to it in one day. And many times you'll see it go well beyond what your average daily range is. ADR not filled at New York open, but during London close, are ideal. The reason why I state this is because it gives us potential range expansion that has yet to come to fruition on the day. And again, as I preface it by saying that you can't expect ADR to always fill. Just because we see it's looking for a potential 80 pip or 100 pip range for the day doesn't mean it's going to make that number of pips. So, in my opinion, if we look for our indicator to tell us ADR is, say, for instance, it's 75 for the 5-day average daily range of ADR, what I like to do is back off that about 15 pips. Because even if I'm exiting early, I may see the average daily range fulfill, but then sometimes it'll not get to it. But if I get out 15 pips before the average daily range, high or low, I have a great deal of probability to be profitable and not have to demand myself to be right. It's not about being right, it's about being profitable. So there's a couple ways you can handle that. You can take your full position off 15 pips before the average daily range, high or low, respective to the daily range direction. Obviously, you're going to be looking to take profits at average daily range high during bullish days and average daily range low in bearish days. But whatever that average daily range is, I want to be taking the bulk of my position off, or scaling the bulk of it off, about 15 pips before that number, because everyone's data is going to be slightly skewed. No one has the right number. No one has the absolute. Okay, so there's going to be some variance amongst all data providers and brokers. So if there's that variety amongst what daily highs and lows are going to be intraday and on the daily ranges, the understanding is that, you know, we have to build in a model that helps facilitate efficient exits. And again, this is one of those things I talked about, you know, in the live session of this particular day of this recording. I was discussing how my efforts in my trading have been more aligned about getting out with more efficient exits, not so much the entries. I don't mind the entries. The entries are okay. The problem I'm having as a old dinosaur trader is that I want my exits to be more efficient, and I want them to be more accurate. And I have built in the model of 15 pips before the ADR as my exit. So many times, and if you watch some of my trades, you'll see why now, with this explanation, why I'm always exiting just a little bit earlier. And it's always a uniform 15 pips before ADR. Now, if ADR fills at or before New York Open, the average daily range will likely be exceeded, especially if high impact news is due out after equities open. That means after the stock market opens at 9:30, if ADR has been filled right at the opening of New York or during the London session, chances are, if there's going to be high impact news later on in the afternoon or at 10 o'clock or 11 o'clock, chances are we're probably going to see average daily range be exceeded. It doesn't mean double, it just means exceeded. So when we look at these tools, again, they're just that, a tool. They're not a secret weapon. They're not a silver bullet. You're not going to be perfect trader, Trader X, Mr. I'm going to be able to accomplish everything now because I have this indicator on my chart. You'll see that it, again, just complements everything else in our toolbox. Is it essential that we see average daily range on our chart? No. And that's why I spent a lot of time during this mentorship not even including it. But because we have a lot more tools and a lot more perspective now, we went from a higher time frame all the way down to these smaller micro moves inside the daily range. We can now start fleshing out ideas on how these little movements intraday line up with the larger moves. And by using tools to help us determine the probable expansion or the magnitude of how big that daily range is going to be, it helps us frame ideas on where the market may go for objectives. So we're going to be blending time and price.
If you have tried a prop firm challenge and failed, or you've never had time to try it, listen to this. We passed the challenge. All
right, so in a nutshell, the scalping model that I use, essentially, the setups are micro setups on the 5-minute charts that we outline on higher time frame charts. So everything we've seen happen in explanation across the board on all the setups in the previous months of this mentorship, they're all applicable to the lower time frame. But the elements of time of day are essential to framing the intraday price swings on every daily range. Now, the higher time frame PD arrays will draw price. They're the catalyst that makes price move. So you have to understand where they are relative to the higher time frame. And the intraday lower time frame PD arrays will provide the timing and or price levels to enter on. Ideally, we use scalps to fill in slow periods or enter trades that may have already started and the lowest risk entry has long passed. If you spend your time studying whether the higher time frame is moving higher or lower and wait for small range days to form, the market will reward your patience and supply you with daily ranges that expand and form clear intraday swings, perfect for scalping. Not all of us are going to lean towards scalping or intraday scalping or short-term price movements in a daily range, because the daily range is very limited. The range can be small. In recent months, we've seen daily ranges that are very minute in terms of how high the high is and how low the low is. And inside that range, there's even smaller, tighter consolidations that we've had to contend with. So just because we're in smaller ranges doesn't equate to, well, I'm just going to scalp the market. There has to be some measure of volatility. And what we like to see is when the market starts to contract, we know there's going to be a large range day soon. And when we see those conditions embodied in price action, when we're expecting expansion, when we're expecting that same time the market to be bullish, and we're expecting the market to react on specific news events during the specific trading days that we're looking to trade, Monday, Tuesday, and Wednesday being highest probability, and the key select times of the day, the kill zones, London Open and New York Open. Not so much the London close and not so much the Asian session. If you want to be in here as a hardliner, you can trade in those, but you're not going to get a lot of volatility or bang for your buck. You can scalp very small short-term positions in London and in New York. Now I get questioned a lot. How can you take a small account and trade it up and build it up? And my advice has always been, if you can do it, if you can scalp, that's one way to do it, because you'll be able to get velocity with your money. Now, it does not mean go in there and trade 7% of your account on these trades. It just means that if you put 1% up, you can get 1% made for that session in London. If you are trading one pair and you're really dialed in, you get another trade 1-for-1 in New York, and it's 1%, you make another percent. So you can get 2% in that one day. So while it's not a terrible amount of money, okay, and you're not retiring on it, if you combine that same element of trading with your one shot, one kill, and maybe short-term trading, 1 or 2 day trades, or swing trading, or blend in mega trades, as we'll teach in July for long-term position trades, those will help complement one another. And if you have margin that's being used for one shot, one kill, you may not have a whole lot free. So you can do intraday scalps, risking 0.5% or 1%, and then you can do other things like hedging. In other words, if you have a long euro dollar position on and you're expecting some measure of normal retracement, you can go in and scalp, okay, not the euro if you're in the States, obviously, because you can't do that, but you can scalp the opposite direction in, for instance, like the cable, or you can trade the retracement lower in the euro dollar. You can look for trades like in the euro yen that would see weakness, so you could scalp that euro yen pair and get a little bit of a percentage return, as that larger position, that one shot, one kill, may experience some normal drawdown that wouldn't shake you out otherwise, but you can capitalize on that retracement by trading another pair that's closely correlated to the euro dollar and short it and scalp it in London and New York while it's applicable for that retracement to see unfold in the euro dollar. So you can use scalping as a tool for hedging. You can do it as a save all for if you missed the opportunity to be a seller at the high of the day. You can go into the 5-minute chart and look for a fair value gap and or a retracement up into a bearish order block if you're bearish, and then sell short there, and then ride the rest of the London session and maybe position yourself for the remainder of the day. It's only limited by your understanding and the conditions of the marketplace at the time. And over time, you'll see examples of how we use it, where it's applicable, and in your own trading, you'll also learn where it's most apt to be the best way of trading, especially when we get into August, when we go over how to break the market down completely and into the 4 divisions of how the market is going into accumulation and distribution models. These types of trades, you can build a very small account up. You can do it in short order, but it's not everyday trading. The problem is you're going to see how nimble you can become in these intraday charts, but it'll end up taking you away from the larger time frames if you allow it. And that's not what I've been doing here. I don't want to take your eyes off the higher time frame. That's why we spent so much time working from a higher time frame all the way down to finally these little 5-minute charts. If it was that important, we would have started with the 5-minute chart. But if you don't have all the things we talked about since September, scalping is going to be not the answer, but a problem for you. So with that, I wish you good luck, good trading, and our next lesson gives us the complete outline of what I do on a daily basis from the time I wake up to get ready for London, everything. So I'm actually going to go through the whole process in a video where everything I do normally, where I get the information from, what I do with that information, what I'm...
Let's get to it.
Most traders fail because they're looking for too much. At 20 Minute Trader, we focus on one particular...
Okay folks, welcome back to lesson 8 of the May 2017 ICT mentorship, ICT Amplified Day Trading and Scalping. This lesson is the ICT Daily Day Trade Routine. Okay folks, when it comes to day trading or even scalping, the first thing I'd like to do is consider this economic calendar for the next trading day or the day that's going to be traded. Now this can be viewed obviously at the end of the previous trading session, but generally you want to be knowing what economic drivers are going to be released during the particular day of study or day trading. So we have here the May 30th, 2017. This is the economic calendar for Tuesday, May 30th. So you can see what we look for is high impact and medium impact news events for the day. And next, what I want to do is I want to take a look at the times of those releases respective to the kill zones of London Open and New York Open, because those are the two dominant high volume times of the day. So we want to be looking for those news events that may unfold during those respective times. So during London, we're looking for the higher low form of the day. It's usually under the guise of manipulation. So with that manipulation, we know that generally it's going to be seen with an economic news release or some kind of volatility injection based on what we see on a higher medium impact basis. You want to look for pairs in the London session or the New York session that have a medium or high impact news event. In this case, we have a medium impact news event for the euro dollar at 3 a.m. Tuesday. It's the Spanish flash CPI that's due at 3 a.m. on Tuesday. So we'll be looking for some manipulation to occur at that 3 o'clock hour, which is the heart of the London Open kill zone. So we know that we'll have an opportunity potentially to see a day trade or scalp form around 3 a.m. that particular day, or our next live session. Now, given the fact that we've already highlighted and narrowed down our focus to one particular pair, which is the euro dollar on Tuesday, we know the time of the day we are expecting to trade the form based on the calendar. At 3 a.m. there's a medium impact news event for euro dollar. So now we have to go back to the charts and look for framework about that particular pair, but we first start with the dollar index. Okay, so now we're looking at the dollar index. This is the daily chart. And the first thing we're going to be doing is looking at the last trading day. Okay, that's going to be here. Friday, May 26, 2017. Okay, so what we're going to do is we're going to look for the if to data ranges. So just grab a trend line here. Okay, and anchor it on a higher or low of the last trading day. It's the easiest way of doing it. Drag it to the left.
Of course.
Okay, and let go of it again, and then re-click on it, and then drag it again. Now you'll notice there's a number to the right of the cursor. It's 37, and then it's 38, 39. What I'm going to be doing is I'm dragging that out until it says 60.
Every time you rip a slab pack, Arena Club makes you an instant offer for your card based on its market value. That's right, no.
So it gives me a rough approximation of the last 60 trading days. Now in this case, it's going to be factoring in Sundays, so Sunday's candles. So this is a quick and dirty way of looking for the up-to-data ranges, but if your platform doesn't have Sundays, you don't have to consider this at all. But for the sake of this presentation, we do have a platform by way of Forex Ltd's demo account that does include the Sunday candle. So we have to compensate for that. So you can see here I've added a vertical line on every Sunday using the trend line going back 60. So we have how many trading days here that are Sunday. We have 10 Sundays in here we have to deduct because we don't consider those reliable data. So we have to go out 1, 2, 3, 4, 5. There's another Sunday. 1, 2, 3, 4, 5. So this is 60 trading days in the past. That occurs on March 6, 2017. So we have to include that for our look back. So we have our look back period here. This is that Sunday. Okay, so we have to go one more day forward. Right there. Okay, so it's 60 trading days back. Now that we have that, that's our longest look back period for IPTA data ranges, or 60 trading days in the past. Okay, so using that theory, removing the Sundays, we have our 60-day look back for IPTA data range, the 40-day look back for IPTA data range, and the last 20 days for IPTA look back. So now we have our ranges at which we work for Fibonacci. We look for our PD arrays inside this range. So in essence, what we're looking at is the entire daily chart. Our only primary focus initially is in the last 60 trading days as defined as you see here. You always count yesterday's days 1 and go backwards, skipping Sundays to get 60 days, then 40 days, and then 20 days. And there's your true IPTA data ranges. So that's the range that we're working in for the daily on the dollar index. Every new day, IPTA data ranges add one more day to the ranges themselves, and we cut off one day looking back. So it's always shifting dynamically forward. So once you have this defined, you can create a box like this and just simply move the box one day forward, and you'll have everything each time. It never needs to change. It just keeps shifting forward. You'd have to create a new box for the 40-day and the 20-day respectively, and just shifting those 3 boxes forward, you always have the look back period calibrated correctly with no candles for Sunday. Now, for those individuals that do not have a live trading platform, when you eventually decide on your own when you want to go into live trading with the content, should you decide to do that, I'm never going to tell you when to do that. Obviously, that's part of the mentorship. I'll never tell you when to do that. It's a completely individual decision on your part. I can't tell you when to trade with live money. That's why we operate in the demo accounts. Everything we're teaching here is for demo purposes, but should you elect to trade with a live account using this information, you do so at your own risk. But if you don't have Sunday candles, you don't have to do it like this. You simply just count yesterday's daily candle as day 1 and go back 60 days, go back 40 days, and go back 20 days, and you'll have the IPTA data ranges that keep shifting forward dynamically. When we get to a new quarter, or every 3 months, we anticipate a shift in market structure, and therefore there will be a quarterly shift that takes place. We receive that as potential trend reversals, but we don't always expect it. We could see it unfold, but again, it's not a panacea. It's not a be-all, end-all. We just anticipate a likely shift in direction for the next 2 to 3 months. Okay, so now we can take this off. Okay, now we have our data ranges in here. So with that, we want to be looking at the last 20 days. Where's our PD arrays? Okay, so we have a low here, and we have a high here. For day trading, you're going to operate in those last 20 days most of the time. Now, if we have already exhausted everything inside of the last 20 days in terms of all the PD arrays, we've already traded through any premium array or traded down through and away from a discount array in the last 20 days, which is highly unlikely, but it can happen, you would go back and look into the last 40 trading days for the data range for the last 40 trading days. But in day trading and scalping, you're primarily going to work in the 20-day look back period. So we have this outlined here as the high and the low. And you've seen me do this a lot in my video work, where I just go about doing it, and it's not a big deal. Everybody just sits back and watches it. But we have price trading right here, and we have a bearish order block, mean threshold. We're just going to eyeball it right there. So you have that on your chart. And going above that, we have a gap in here with a breaker here. So what I'll do is I'll always elect to go with the lower first, especially a breaker, because it takes precedence over everything else. So I'm looking at the breaker's low. Notice I'm not counting that wick here. Like traditional support resistance guys, they would use that low here at 98.46. I'm more concerned about the down candle. So I want that 98.53. I want that low.
You pass the challenge. You think you made it. Then you blow the account again. Sound familiar? It's not your fault. It's the system you've been sold. Why do so many traders pass only to blow the account right after? You've probably been there. You pass the challenge, then boom, you blow the funded account. Or worse, you just can't stay consistent long enough to get real payouts. So it's back.
So I'll have that on my chart. Then we also have this level up here. So it's part of the shorter line, so I ain't got to do any kind of adjustments on the length. So I want to notice this also, because this could be. So I'll have that on my chart. Then we also have this level up here. So it's part of the shorter line, so I ain't got to do any kind of adjustments on the length. So I want to notice. This also, because this could potentially be a fair value gap that needs to fill. The high of this candle here, which comes in at 98.14, that begins the fair value gap support, and the resistance is up here. But we also have a rough midpoint that is a breaker. Okay, so these two down candles begins the breaker that which we saw this short-term high being violated and then rejecting lower. So
fishing. Caffeine, man. Caffeine.
Then we know that there's going to be most likely a reason to want to mitigate something up here, even if it's going to be a smaller retracement.
Dude, that taste of caffeine.
But we have to be bearing in mind that this could be a sticking point for price going higher. And then we have a small little fair value gap in here, which we'll delineate. And again, this is on a daily chart, so we're going to have several levels in here that will be seen. But in here we have it's a Sunday gap. Okay, so it's going to be less likely to be that much in terms of an influence. So while we do note it here because it's on a Sunday candle, the gap is essentially all the way up to here. Okay, and we're going to use that last up candle's low as a anchor point. Now for those without Sunday candles, you wouldn't have this on your chart at all, but we have to use it because it's Sunday's small little movement up, then broke down. That may be a short-term resistance point. You don't have a candle on Sundays, you're going to just simply go back to here, which is the last bearish order block, which is up close, wait for the down move. That low closes in the fair value gap. Notice we're not using this one, okay, because it has a down close. We want to see the last up close. That's where the fair value gap begins as its resistance point. So we're down here. There's our levels or PD arrays going on the upside. And notice that in the last 20 days, what we're doing is we're framing the market. Are we in a premium or are we in a discount market? Well, if this is the range, the high.
You're one sentence away from launching your website with Base 44. Since the beginning of the internet, there's never been such a fun, fast...
In the low, would that be right now, if we looked at price trading, say it opened up on Sunday here, or very close to the close on Friday, would that constitute a market that's at a premium or at a discount? Clearly, it's at a discount. Now, because it's in the discount of the 20-day look back, it doesn't mean just go in there and buy it and expect it to go straight up for the dollar. You have to look at where we are in terms of historical reference points. Even though we go back 60 trading days, okay, we are really low in the last 60, the last 40, and the last 20. So we're really down there. Historically, looking beyond the last 60 trading days for a macro view, we have always referred to this low back here in recent analysis because it's going to be influential. So price did sweep below that like we were expecting, and we saw a little bit of a move up. So we are in a discount market with a lot of PD arrays on the upside that could be traded to, even still keeping the bearish tone on the daily dollar index. This trend could continue going lower, but we have to outline where the price could be reaching up to should it start to move higher. Now for the discount arrays, because we've done all the premiums, which is above market price, where we're at now and what's below us, we have a bullish order block right here, the last down close candle right in here, and we'll draw that out. Okay, and I'm going to disregard any mean threshold here because it's already worked on both sides of that. But this candle here, this last down candle, has been violated by its high being 97.42. We have a high on this candle at 97.44. So now this candle also becomes a propulsion candle, which is another order block that's bullish that creates a higher high. Now I'd like to see them a little bit more separated than this, but we refer to that level as well, and we'll use that one going forward. And that was also validated on Friday by a move through that candle's high. So we have this level at 97.38, which is the opening, or 97.39 in this case, close enough. We'll use that as a bullish order block. basis point for discount. So now we have all of the PD arrays for the dollar index in the last 20 days. We do have a rejection block down here with the lowest down close, so we also have that as well. Okay, so every one of the PD arrays are now labeled or delineated on the daily. And now we got to look at what is institutional order flow for this market now. We're seeing, in the last 60 days, we're seeing up candles, which are bearish order blocks. When price moves down away from it, it's being respected here. Up candles here after a void, prices trade up to it in the last 40 trading days. It's respected that. It's gone lower. We've had a gap in here. Price traded up into that, filled it. It's sold off. Price has broken lows. So institutional order flow for the dollar index is what? Bearish. So we have to elect to decide on looking to go short, preferably. That's where the highest probable trades are with odds in our favor. But since we're day trading, we can counter trend trade that if we have the ranges defined in a form of a discount. So we're already in an extreme. Especially down here we have this old low we traded down below. So there's a potential reversal scenario that we could see some measure of retracement. It doesn't have to retrace, but we can reasonably expect it to. So we've seen this down candle trade through, and we have a couple different gaps up in here, and we have a last up candle right in here, small little rejection block right at that candle's close as well, which I won't add because it's just going to be one more level on here, but we would add that as price got closer to it, but you would consider it also in your own notes. But to keep the charts clean, that's what we would do. Now you would take this same element and add it to the Eurodollars daily chart, and we'll do that now. Okay, so we have the IFTA data ranges for 60, 40, and 20 on the Eurodollar daily chart now. And now we're going to look inside the last 20 days, look back period, and we're going to identify the range. So we have the high of the last 20 days is here, and the low in the last 20 days is here.
Why can't most traders get funded even when they can spot setups, read price action, and understand the market better than almost everybody they know? I can tell you that it's not because of the knowledge, it's not because of the screen time, and it's definitely not the effort. It's the constant strategy hopping. It's letting emotions hijack their trades. It's confusing being busy on the charts with actually being productive. I mean, think about it. Why would...
Okay, so we are in what? Discount or premium? Referencing the last 20 days. We're at a premium. So now we also go back here and look at a historical high, okay, because you have to have a macro perspective. We've traded above this old high, forgetting this wick, disregarding that wick rather. We've traded above an old high. We are in the last 20 days range. We are at a premium. So now we're going to go through and add up all the discount arrays that would be below us in price. So you go through and you grab a little trend line here. We have an order block here, bullish order block, so we have to frame that. I'll take this vertical line off. Okay, and so we have a bullish order block here. You would note the mean threshold as price gets down to it as well, but we're going to keep the charts very clean for right now. And we have a fair value gap that begins with this candle's low down to this candle's high. So we have our liquidity void here. Fair value gap is in here. And inside this last 20 days, we also have an old high. So we have to reference that. You can see how nice, by understanding the data ranges, it limits your focus to what's only salient at the time, right now. Like what's important, what's the things that you need to be concerning yourself with. These operations and concepts is what helps you arrive at that. So you can think about Price algorithmically like IPTA does. And we have a small little fair value gap down here as well. Should price find its way back down here, we have that small little area in here that could fill in. And let's extend it out a little bit more in time. So there are our discount arrays, and the premium arrays we have is the rejection block on the last up highest close here. So we'll have that. And then we have the old high naturally that forms the 20-day look back periods range high right in here. And that's it. Now we simply go down into a 4-hour and we do the same thing. After we note what's the institutional order flow right now. Well, you can see in the last 60 days we had down closed candles, which is bullish order block. When price moves away from it, price has respected it. Yes. Okay, we had down candles here in succession, which is one big bullish order block. Price hits it and trades away. Price comes back down, trades into that same order block here, and rallies away. We have a gap that also has to be considered, but we're not going to do that here because it's a great deal away. But this would also be noted on your charts as we got closer to it. And then we can go into these last two down candles right ahead of the gap closure. Price trades down into that and below these old lows for liquidity pool. Rejects, trades higher, and we've had yet to come down here and really try to capitalize any bullish order block here. We worked on the wick in here on this candle and on this candle here, but I think it's going to want to try to come down into there because we are at a premium, but we have to be mindful of this opening and the mean threshold. If that gives way at the mean threshold, then we're going to be looking for the fair value gap to be a likely candidate for filling in, going down to around 110, 15, 110 big figure. So let's go down into a 4-hour chart. Okay, here we are on a 4-hour chart for the euro dollar, and you can see how all the daily PD arrays in the last 20 trading days look back for IPTA. We can see where IPTA will be looking to consider where liquidity may be resting, or giving traders at the bank level an opportunity to get in and capitalize orders, whether it be long or short. Now, since we're on the 4-hour chart, we have to again consider what the longer term institutional order flow is on the daily chart. It's higher, it's going bullish. While we are in a premium relative to the last 20 days and certainly the last 40 and 60 trading days, this could be just a opportunity for price to retrace back down to gather up discount arrays to capitalize new long positions. So when we look at the 4-hour chart, what we're going to be doing is we're looking for PD arrays, yes, but we're looking for reasons to justify why price could be going down to gather up liquidity for an offset accumulation. So when we have price like this, trading in small consolidation like this, and we have a higher time frame daily PD arrays, what I like to do is I like to see, okay, if I know the institutional order flow on the daily chart is bullish, I want to first make a case and argue that there's reasons for them to want to take it down, to take out sell stops, to accumulate new long positions. So that could be done by two different things. We can see that the lows that was formed here and here, price can go down below that and hit the higher time frame PD array. Okay, or we can trade down below this one because we have this old low and this old low, so price could stab down below that and basically operate under the guise that we are in a premium market, but it could drop down to a short-term discount market relative to the 4-hour chart. So what am I saying here? Well, we have another little range in here from this low to this high. So if we frame that with a fib in here.
Factor just solved my boring dinner problem. With over 100 weekly options, I never have to eat the same thing twice.
Okay, we have optimal trade entry in here, which would be below equilibrium, which is in a discount. And we would be also operating on this down close candle, which is a bullish order block, which is at 70.5 level. So that's a level we will be watching to see if there's any sensitivity should price trade down to it. You'd have that as a level to be considering. And we have the total range from this low down here. Okay, equilibrium is below this low. And then we have a little bit of a gap in here, a lot more gap in here, which is an optimal trade entry also. So we have a little bit of a gap in here, closure. Then we have this old high back here as well. So price could come down and retrace from the premium market that we're in on the daily. It could trade all the way down into a discount on the 4-hour, just to give an opportunity for banks to capitalize new longs at this old high and close in some of this fair value gap. Now notice the fair value gap in here. Let me get the fib off so you can see it better. The fair value gap with only buy side delivery, that can fill in down here, and it can retest all this old high and go down below a little bit. So we could look for this daily PD array at 109.90 to be the basis for a discount reaction on a higher time frame bullish institutional order flow for the euro dollar. So what am I saying? I'm saying that should we break these lows in here and should we go below the order block here, we're going to go down to 109.90 most likely, or this old high back here, which comes in at 110.15. So either one of these two levels here are better for a buy, but while we're up here, price, we can reasonably expect to see it sell off. Now, if we see price trade through the up close candle here, which is a bearish order block or a bullish candle wait for this down move, if we lose or trade above the mean threshold of that candle there, because we have to look at the PD arrays on the 4-hour chart, which we're doing now in conversation. If we go through that, that would nullify any near-term 4-hour bearishness, and they're going to want to run it higher. So if we do that, we trade through this last up candle. If we trade through that, then we're going to be looking at these two down candles as a potential bullish order block on the 4-hour chart once this up candle is traded through on the upside. So if we violate this entire up candle or bearish order block, then we have to turn our attention to these two down candles, which will become at a later time a potential bullish order block. So we would be looking at the open on this candle at 112.20 and the high at 112.37. So basically it could be 112.40 to 112.20. In that range we could be looking for it, and we're going to look down into a 60-minute chart in a minute, but that's how we would map out two scenarios. Well, obviously we have to justify the higher time frame daily institutional order flow being bullish. So you look for arguments that would say, okay, if price were to drop down, why would they want to drop it down? Well, they want to take out equal lows, take out some stops, okay, and they can come back down into this order block here relative to the 4-hour chart. But we are referencing the daily more than the 4-hour. So we have these PD arrays, which is this old low, so price can trade down below that. And if it trades down below that, this old high becomes influential, okay? And obviously we'll get more detail as we go, but you start looking for scenarios of why and justify why the argument for continuing a higher time frame institutional order flow should be the case. But if you can't make a sound argument for entries based on that, then you have to start electing to say, okay, we are in a premium market. Maybe the market needs to go down into a discount, yes, to go higher. But if it takes out specific discount arrays, then we're probably changing tide, and it's going to want to go lower, more on an intermediate term basis versus a short term basis. So we're going to drop down to a 60-minute chart and do the same thing, understanding that if we look with Control Y, this would give us our weekly perspective, or what the weekly ranges look like from a profile standpoint. We can see each week it opens, trades down, and comes off the low. It starts this week, trades all the way up and closes on the high of the week last week, and well, not last week, the week before, the time of this recording. And then the last week we just closed, at the time of this recording, we've had basically a consolidation week. Okay, so while it has had opportunities to sell off, and we've seen those unfold, overall, this market or pair, the euro, has been in consolidation this week. So we know that there's a support level that's created for this week, and if we trade down below it,
Wisconsin's families are underwater. I'm Tom Tiffany, dam tender on the Willow Flowage for 29 years.
we have an order block to watch for potential new buying in. And if it trades off of there and starts to go higher, we know that we can anticipate bullish institutional order flow on the 4-hour chart, and to see if it's supported on the daily as well. And then we can continuously go into the market looking for longs, which is what we'll start building cases for now on the 60-minute chart. So let's do that now. Okay, so now we have a 60-minute chart of the euro. Okay, and now we have all the individual days broken down with the Control Y used. But so now I'm going to take that off for a second. We'll come back to it in a moment. So now we have a clean chart here, and we see the equal lows, this low here and this low here. And below us, again, this is a daily PD array, we have below us, we have the discount array of this bullish order block, which is these 2 down closed candles. Now I want you to take a close look. Again, we're looking for confluences of PD arrays to overlap with one another and justify if they're going to take this market lower. Is it going down just to give them an opportunity to buy at a cheaper price for longer term institutional order flow being higher to unfold and look for those 113s, 114s on the euro? Or are we going down for a more sustainable move? We can't guess that yet. We can't determine that yet. And don't ever try to think that you can. We are looking for probabilities. Right now we've been in a consolidation, so they could be taking us in a consolidation to build a larger liquidity pool of sell stops below the marketplace and then drop down to take those sell stops to capitalize new longs on. If they're doing that, where could they do it? Well, on a hourly basis, a PD array, we have a fair value gap right in here. Starts at this candle's high and this candle's low. So in here, we have a fair value gap. So right here, this is a fair value gap, and to the left of it, we have 2 down closed candles right for a nice move. So we know there's a bullish order block right there. So we have a convergence of 2 discount arrays right here, and it's below the equal lows. Okay, so the low comes in at 111.62, and this level comes down here. It starts at a low of 111.36, and the high on this candle for gap support would be 111.30. So 111.30, 111.35 should price trade down to that level. Okay, we could expect some measure of bullishness. Now, how do we use this information? If price trades down to this level here, okay, if it does that, we want to be in a 15-minute time frame and look for our standard deviations. We want to be doing the central bank dealers range. We want to be doing the flout, which is central bank dealers range, and Asian range standard deviations. And we want to project them above and below the marketplace, giving us potential targets to reach for. But also, we want to be looking at the opening price. When price trades down to this level, we want to be looking at the opening price at 0 GMT and the opening price at midnight in New York. And what we'll be expecting, if we're expecting some measure of bullishness in here, we're going to be looking for what? The open and a very small decline, if at all, after the opening at 0 GMT or midnight in New York on a 15-minute candle, or 15-minute chart rather. And by having that protractionary state of the market where it opens and trades down from 0 GMT or midnight candle in New York, if it trades down below that opening price, we would expect at this level or very close to it to be a buy for a day trade. That expectation would be for the London session that particular day. If London fulfills that, we would expect some measure of continuation on the New York session. But if the New York session trades up to, say, these levels up in here, okay, we have a lot of resistance in here, so that could promote a New York session reversal. So that way we're already framing scenarios. Is what you have to do is go through your templates and think about, okay, the idea is we have already come down to this level, and there's some bullishness here, and run scenarios in your mind and build a plan. Now, you can't just say, okay, this is the only way it's going to unfold. This is the only way that it can happen, because believe me, it can do a lot of different things. But generally,
most traders never pass their prop firm evaluation, and the ones who do usually blow the account right after.
If you think in generic terms, if we're bullish or bearish, there's only a few templates that you can use based on the day of the week that it trades down to this level. Remember, if it trades down there onto Monday, well, Monday's a bank holiday in the U.S., so I would be more unlikely to be trading that. But for observation purposes, if it does it, you can see it. But Tuesday, when we go back to our live sessions again, it'll be the day after the holiday, and if it trades under that level, we can reasonably expect to see an open, decline, power 3 formation, and an up close, or at least for the London session for a scalp. Then New York, we look for evidences to see if it gets up to that level. Does it have willingness to go through it? If it does, guess what that means? This run down was for stop runs below here, and then institutional order flow will be kicking back in bullish from the daily standpoint. And then we have to switch gears and look for continuation on the upside, which is another open down move or Judas to buy at 0 GMT or at midnight in New York. And then look for runs on the liquidity above the marketplace in the premium capacity. But should price fail, and say price gets down to this level here, and you try to do a buy, and it fails and stops you out, then you have to go out to a little bit longer perspective and consider what these daily PD arrays may have impact for. We have equal lows below here, and then that fair value gap down here, and that old high. So if we lose the opportunity to find a long at this level, because it's a bullish order block and fair value gap, and it's below the equal lows, so if IPTA drops down and no banks come in and step in to capitalize there, well, you'll get immediate feedback by being stopped out. And then if it does that, we'll anticipate price running below these lows, not for a buying opportunity, but for targeting purposes for expansion. So we could potentially see a sell-off at this level's failure. So we can see a return back to fair value, bearish order block, fill in a fair value gap, liquidity void, and then sell off to a run down to this level here, closing in that gap as well. So there's a formula at which we go through. We start with liquidity injections, or volatility injections rather, by looking at the economic calendar, framing the time of day, what influences on what pairs are we going to have for London and New York, and then we go in and get an analysis baseline on the dollar index, determine if the data range, look at the PD arrays, consider the PD array matrix, are we in a discount or premium market. Then we go into a breakdown of the pair that has the news driver coming out at that session. We know at 3 o'clock on Tuesday, May 30th, 2017, there's going to be a medium impact news event. So we want to be anticipating some measure of manipulation. Now, what could that be? Well, Monday and Sunday could see this level traded too, so I can't forecast that. But say we stay in a tight range, okay, or we trade a little bit higher. At some point on Tuesday or Wednesday, if we trade down to this level here, that could be a Tuesday low of the week or a Wednesday low of the week. You have to think about those weekly templates. So if we're looking for reasons to justify why the longer term daily institutional order flow, which is bullish for Euro, could resume by going down to here, then that builds the case for watching the rest of the week unfold. But what day of the week does it hit that level? Consider your weekly templates. If we're looking for the reasons to justify a continuation of the bullishness on the daily, which is always the case, we're looking for daily institutional order flow to give us our directional bias. But there are times where, like we are right now on the Euro, we're at a really high premium, and it may require it to consolidate longer than we've seen here last week, or it may need to do a deeper retracement down to a discount market to allow banks to buy it at a cheaper level, and also offset and remove those individuals that are already long that are very aggressive about trailing up their stop losses, or maybe even below here. And they can come down through all this, capitalize an old high, and folks could be looking at this as a potential reversal long term, and it very well may be. I'm not trying to pick a top in a year. I mentioned that earlier last week in our live sessions. I don't want to do top picking, okay, because the market is showing primarily it wants to go higher, and it's very strong in the case of its bullishness on the daily. So we don't want to fight that. We don't want to stand in front of it because there's large funds and flows going into this currency. So if that's the case, we need to be justifying reasons to go in and long. So the routine is in summary form, as you see here.
Unlock the world's largest, most liquid financial market.
Everything we do here in this list is one step at a time. We break it down and we look at all of those elements. When we get to the point where we're looking at a 15-minute time frame, you would be adding the standard deviations for the central bank dealers range, the Asian range respectively, and the flout. So by having those deviations and also incorporating the average daily range, if there's a confluence of those standard deviations, ADR, and a PD array on a 15-minute basis, or the 60-minute or 4-hour PD arrays, then you know there's a high probability for price to want to expand higher or lower to those respective levels. When I'm picking daily highs and lows and I'm getting really close to it, sometimes right to the pip or a few pips away from it, this is the procedure I'm using. There's nothing else that I'm doing that's secret. There's nothing else that's mystical about it. There's no other indicators that help me do it. It's the work of looking at it and using the templates that I've given you for the weekly and for the daily. So if we know what we're expecting in terms of a scenario, if we're bullish, there's only so many weekly templates that outline the range for the weekly range to be bullish. So we look for evidence to support those. We obviously start from the Monday low of the week, and if Monday doesn't give us enough evidence, we look for Tuesday low of the week to form. And if Tuesday starts to trade up, then we know that Wednesday's probably going to be a good buying day to scalp longs in. And we can do that all the way up into Thursday's New York Open, where we can basically expect the weekly high to start to form. Doesn't have to, but that's the conditions we anticipate. And then if Thursday continues higher, then we know that there's probably going to be some profit taking on Friday, so try not to buy on Friday. Either move to the sidelines, don't do anything, or look for currencies, okay, that
Today we're making quick and easy refried beans. Heat the olive oil in a large skillet. Saute chopped onion and jalapenos for 4 minutes. Now add the garlic and ground cumin and saute for 1 more minute. Pour in canned beans with liquid, season with salt, simmer for 10 minutes until thick, then blend or mash the bean until smooth. Stir in the fresh lime juice, and so important. Then serve hot, garnish with cilantro, and enjoy your homemade refried beans. Easy, right? Today we're making quick, solid.
Here's how my